On May 7, 2026, a member of the European Central Bank's Executive Board stood up at the London School of Economics and told the room that central bank independence was under threat, and then spent most of her lecture arguing that the threat everyone was already watching wasn't the real one. Footnote 1. Isabel Schnabel wasn't talking about lawsuits or fired governors or Supreme Court rulings. She was talking about something with no plaintiff, no defendant, and no ruling that could fix it. 2 weeks later, the institution she was implicitly gesturing at got its answer to who'd be running it. Kevin Warsh was sworn in as Federal Reserve Chair on May 22. Footnote 2. His first meeting in June was unanimous, a courtesy most analysts figured, extended to a new chair finding his footing. Footnote 3. His second meeting in July, split 3 ways against him, the sharpest dissent the Fed had seen since 2016. Footnote 4. 6 weeks. 2 meetings. A committee that went from complete agreement to open disagreement fast enough that nobody watching it closely can tell you with any real confidence which direction American monetary policy is actually pointed. Here's the thing about the rest of the world's central banks. For 25 years, they've quietly taken their cues from this one. And right now, the one they're all still calibrating against is visibly, publicly working out what it even is. Start with a mechanism most coverage of central banking treats as background noise instead of the actual story. Central banks around the world don't set policy in isolation. They set it in the shadow of whatever the Federal Reserve is doing, whether they admit it or not. The academic groundwork for this goes back to economist Helene Ray's work on what's known as the global financial cycle. The finding that capital flows, credit conditions, and asset prices across dozens of countries move together in a pattern driven disproportionately by U.S. monetary policy and the dollar's role as the world's reserve currency, regardless of each country's own domestic conditions. Footnote 5. In practice, that means a central bank in, say, Seoul or Stockholm isn't just responding to its own inflation numbers. It's responding to what it expects the Fed to do next, because dollar liquidity conditions will move whether that country wants them to or not. This isn't a new observation either. Financial commentary tracking central bank behavior has noted, in general terms, that advanced economy rate setting has grown steadily more synchronized around Fed policy over the past quarter century, consistent with Ray's underlying framework, and that the synchronization is what's now visibly breaking down. Footnote 6. This show would rather understate that pattern than attach a specific number to it that couldn't be traced back to a primary source. The behavioral evidence in the rest of this section carries the argument without needing one. Here's why, laid out in sequence. Jerome Powell's term as Fed Chair ended May 15, 2026. Kevin Warsh was sworn in a week later. Footnote 2. His first meeting chairing the FOMC June 17, produced a unanimous 12-0 vote to hold rates, alongside a statement roughly a third the length of what had become standard under Powell, a deliberate break from the Fed's recent practice of extensive forward guidance. Footnote 7. 6 weeks after that, the July 29 meeting split 9-3, with 3 regional Fed presidents, Cleveland's Beth Hammack, Minneapolis's Neil Kashkari, and Dallas's Lori Logan, dissenting in favor of an immediate hike, the widest hawkish split the Fed had seen since September 2016. Footnote 4. Worth noting who didn't dissent. Fed Governor Christopher Waller, despite voicing his own inflation concerns beforehand, voted with the majority to hold, and Powell himself, who remained on the board specifically to help steady the institution through this transition, is not named among the dissenters at either meeting, meaning he backed Warsh's call rather than undermining it. Footnotes 4 and 8. Worth complicating the Warsh broke it version of this story, because the honest version is less tidy. The fracturing predates him. The April 2026 meeting, under Powell before the transition, already produced an 8-4 dissent, the widest split in more than 3 decades, with then-Governor Miron voting for a cut while 3 other members pushed the opposite direction. Footnote 9. Warsh didn't inherit a unified committee and break it. He inherited a committee already pulling apart, and then made a specific, deliberate choice, cutting forward guidance, shortening statements, that's made the pulling apart more visible to everyone watching from outside, including everyone whose own policy used to calibrate against how clearly the Fed signaled its next move. This is where Schnabel's actual argument comes back in, and it's sharper than other countries have political problems too. Her May 7 lecture named 2 specific mechanisms she considers more dangerous than direct political interference: precisely because neither one requires anyone to attack anything. Footnote 1. The first, fiscal dominance. As government debt rises, the argument goes, a central bank's room to raise rates without conflicting with its own government's borrowing costs quietly narrows, not because anyone ordered it to hold off, but because the fiscal consequences of tightening become harder and harder to ignore. The second, financial dominance. A fresh wave of financial deregulation risks pulling central banks toward prioritizing financial system stability over their actual price stability mandate, again without any single decision that looks like political capture. Schnabel's own framing is worth stating plainly. These threats are more serious and enduring than the visible political fights, specifically because they evolve gradually enough that no single moment forces anyone to defend against them. She didn't leave the American situation out of it either. She cited Jerome Powell's own April 29, 2026 press conference remarks, in which he referred directly to legal attacks on the Federal Reserve, using the U.S. fight this show already covered in the previous episode as the visible, easy-to-point-at threat, while arguing the structural ones are the ones actually worth losing sleep over. Footnote 10. And the rest of the world isn't just theorizing about this. The IMF's own research department is now planning a formal review of forward guidance practices, prompted specifically by Warsh's reduced communication, with, in the words of one IMF official, other global central bank leaders already expressing reservations. Footnote 11. That's not a philosophical objection published in a working paper months later. That's an international institution organizing an actual response, in real time, to a sitting Fed chair's specific communication choices. Here's the through line worth stating directly. An anchor that other central banks have spent 25 years calibrating against doesn't need to be captured, sued, or legislated against to stop functioning as an anchor. It just needs to become unpredictable enough for long enough that the rest of the world can no longer confidently read it, and once that happens, the fiscal and financial pressures Schnabel described get harder to resist everywhere at once, not because independence was attacked, but because the reference point everyone used to measure it against started moving. Every door has a locked room behind it. This one doesn't have a door in the usual sense, and that's exactly the problem. Episode 17's locked room was defended, eventually, with a lawsuit, with a leaked internal memo, with a Supreme Court ruling that came out 5-4 instead of 6-3. Whatever else was true about that fight, it had a mechanism for being fought. A plaintiff, a defendant, a process, an outcome. This one doesn't. You can't sue a sovereign debt level. You can't depose a deregulation trend. There's no injunction available against a shortened FOMC statement, and no court anywhere has jurisdiction over whether other central banks still trust what they're reading in one. That's what makes fiscal dominance and financial dominance genuinely harder problems than a fired governor, even though they generate far less dramatic coverage. A legal attack forces a decision. Someone has to rule publicly on the record, and the institution either survives the ruling or it doesn't. Structural erosion never forces that decision. It just makes each individual choice, hold rates a little longer than the data alone would suggest, ease up on a capital requirement, let a statement run shorter to avoid committing to a path that might need reversing later, look reasonable enough in isolation that no single one of them ever becomes the moment anyone has to stand up and defend the institution's independence outright. This is a locked room with no lock and no room, an erosion with no identifiable defendant, propped up entirely by every relevant actor choosing, meeting after meeting, not to spend the last of the institution's credibility while there's still some left to spend. Nobody has to lose a court case for this one to fail. Everybody just has to keep making the locally reasonable choice for long enough, and the anchor stops holding without anyone ever formally deciding to cut it loose. Step back and the stakes here reach past monetary policy into something this show is about to spend its next 2 episodes on directly. If the Fed's signal genuinely becomes harder to read, not captured, not compromised, just less predictable than the 25-year pattern the BOE's own data measured, the rest of the world doesn't just shrug and wait for clarity. It starts building redundancy. Countries and institutions that used to plan around reasonably confident expectations of where U.S. policy was headed start hedging against the possibility that it might not behave the way it used to, which changes everything from currency reserves to trade financing arrangements to which smaller economies suddenly matter more than their GDP would suggest, because they offer some kind of buffer against exactly this uncertainty. That's not a hypothetical connection to whatever comes next on this show. It's the direct mechanism behind it, An anchor that used to be reliable enough that the rest of the global economy could simply build around it is now something every serious economic actor has to actively hedge against instead, and hedging against an anchor is, functionally, the first step toward looking for a replacement or at minimum, a backup. 25 years of the world's central banks quietly moving in the Fed's shadow, and the thing that finally started to break that pattern wasn't a scandal, a crisis, or an attack anyone could point to and say, that's the moment it failed. It was 2 FOMC meetings 6 weeks apart, that went from unanimous to fractured, plus a decision somewhere in Frankfurt, that the more dangerous threats were the ones nobody was watching closely enough to notice. Nobody had to win this fight for the old certainty to end. It just had to stop being certain. Next time, who gets to matter more when the countries and companies that used to plan around a predictable anchor start looking for something else to hold on to instead?